All right, let's kickstart the first conversation of the day. Joining me to talk about the volatility that is currently part of our lives in equity markets and otherwise is Rushabh Desai, the founder of Rupee with Rushabh Investment Services. Thanks, Rushabh, for taking the time. Let's start with the context. Why is it that we're seeing such a degree of volatility?
Alex, thank you very much for having me on your show. So, Alex, there are various factors which is making this market equity and debt volatile. So, let's try and understand these few factors. One is the Russia and Ukraine war. So now, due to this war, a lot of commodity prices have been spiked up. US has banned the Russian oil. Due to that, the Russian oil prices have also come up. Now, on the other side, there has been a slowdown in the Chinese economy due to COVID lockdowns and stuff. Now, due to this, the supply chain has been disrupted globally as well. Now, all of these factors are indicating and are giving immense pressure on the inflation. That is why the inflation also is spiked up. Now, we are also seeing, so majorly inflation has been on the supply side, but as in how the economies have started to open up, we have seen the inflation coming from the demand side as well. Also, there has been a good credit growth cycle currently what we are seeing. It's not at its peak, but it's slowly doing good. The demand for loans are also increasing. So demand side of the inflation is also putting a lot of pressure. Now, when the inflation is spiked up, what do the central bankers do? They have no choice but to raise interest rates to suck out liquidity from the market. So when the liquidity is sucked out from the market and when steps are taken to tighten liquidity, you will see the money, going out from the equity markets. Thus, you will see volatility in the equity market. Also, on the other side, the dirty money, what was there in the equity market, has been slowly ventured into the fixed income space because the yields are also coming up. So all of these factors are putting a lot of pressure in the equity market. Inflation is the main reason. And in the debt side, when the yields and the bond prices share an inverse relationship. So when the yields in the bond market, in the fixed income market increases, the automatically existing bonds with lower coupon, their value automatically falls down. So these are the few combinations, in my view, is causing a lot of volatility in the equity and the debt side.
Fair enough. I think you've summed it up very well. And in fact, to your point on foreign institutional investors selling, they continue to do so, Rushabh, in the Indian equity markets. They've sold quite significantly, over 50,000 crore rupees in the equity markets in the month of May itself. But let's talk about how long this volatility will last, because I think that's the question that globally investors are asking. I don't know how much people have been able to predict, because to a certain extent, there's also a fear of a recession in the US, right? So can you perhaps give, what are you telling your clients as to how long this volatility is likely to last?
So, I mean, by now the Russia and Ukraine war should have been subsided. That is what it was. That is what it was understood. Because a war cannot last for so long. You need immense amount of resources, right? But the way it is being carried out, I don't see the war cooling off soon. Now, I also don't see the inflation also cooling off soon. So, the central bankers throughout the world are aggressively going to rate hikes for 2022 and early 2023. Also, as you correctly pointed out, that currently we are not in a slowdown, but if the inflation and the commodity prices are not cooled off and the supply chain issue is not subsided, we may enter a slowdown and maybe a recession as well. So expect volatility both in the bond market and in the equity for at least till 2022 for sure.
Okay, fair enough. So there is going to be a significant amount of volatility. The question then is, in the current market scenario, what should investors do? And this is now a broad swath of investors, right? You have investors that have chosen to deploy funds in 2022 or rather 2020. They have ridden the storm over the course of the pandemic. They've benefited from the gains in equities. They're facing losses now. There are new investors that are entering the market. Some investors have lump sum. So what is the advice that you're giving people on how to deploy their funds into the market right now?
Okay, so at this point of time in the equity markets, investors should not panic. the whole focus should be on the earnings, right? As long as companies are delivering robust earnings, I really don't think the price compression and the valuation compression is going to be of a great worry. I'll just give you a small data. Earnings of 27 Nifty 50 companies have risen by 21.38% in the quarter ended March 2022. So the earnings are also coming quite good. Of course, there will be certain pockets which may not do good and which may take a little longer time to recover. But at this point of time, we are simply noticing price and valuation compression, nothing else. Prices and valuations have turned out to be reasonable, so investors should use this dip, to accumulate more in equities. Now, for SIP investors, I wouldn't suggest they should stop investing, because they will lose out the benefit of the rupee cost averaging. So SIP, the whole purpose of SIP is to invest during highs and lows. I mean, the more the volatile the market is, the more the SIP investors will actually benefit in accumulating more units. But when it comes to lump sum investors, because we don't know the bottom, we cannot predict the bottom. So stagger your investments for 3 to 6 months time frame.
And you would suggest doing that using an STP route? If they're choosing mutual funds, you would say that it's a good idea to, deploy in a debt fund and then push it into the equity fund using the STP route?
Absolutely, a liquid fund is the best product in this scenario. Either park it in a liquid fund or an overnight fund, and just simply do an STP either weekly or monthly, whatever suits the investor the best for 3 to 6 months time frame.
The next question relates to certain pockets, and you mentioned that certain sectors will take a little longer than others to recover, and perhaps you might just see stress. It could well be the metal sector, it could well be the energy sector. You don't know what is going to happen in the near term. So, what I'm getting at, Rushabh, is that are there any pockets in the mutual fund universe where you're advising your clients that it's better to not venture into right now? Of course, on the fixed income side, there are very clear no-nos, right? But what are those pockets where you're saying don't venture in right now, it's too dangerous, it's too risky right now?
So taking any sectorial and thematic bets is absolutely avoided. It is a big no-no. The reason is because it is very difficult to predict sectorial cycles. Even if a sector has drastically fallen, if it doesn't do well, it can take a very long time to recover. I'll just give you a small example, Alex. So the pharma index, from its peak in 2015, it didn't do well until 2021, Alex. It was in a stagnation. It delivered no returns. So practically 7 years of absolute no returns, right? And even as we speak, the correction what we are seeing, it is still in the negative zone from 2015. So don't try and take sectorial bets. Don't try and take thematic bets at this point of time. Diversified approach is the best way to invest and go ahead. Also, if I also see, I suggest my clients or the investors stick to the 4 pillars: know your goal, risk appetite, time horizon, and asset allocation. Once you know this, only and only select a product. Don't just select a product just because a product or a sector has fallen down by say 20, 30, 40% or so, And if an investor has selected, for example, a product out of this particular box, immediate review needs to be done. And if the investment is in positive, I would suggest that the investor get out from that product and invest into a product where it suits the client or the investors well.
There is also a debate at certain times, and this is one of those times, Rushabh, when it comes to the large cap end of the spectrum, right? Where when times are good, when the bull market is roaring, you have a lot of people saying, index funds are the best way to go. But on the downside, because you have no protection against the downside in an index fund, and you're not picking and choosing stocks, they say that, active funds might just be better because they have downside protection. What are you telling your clients?
So, Alex, this is a very lengthy debate, in the industry, unfortunately. But there is no doubt that well-managed active equity funds have provided better downside protection. But see, if you're venturing, if someone is investing in any active pure equity fund, the focus should not be on downside protection, right? You're investing in the equity market for long-term period. So the focus should be on the long-term consistency of that fund in delivering outperformance and generating alpha. So I wouldn't, if someone is looking for downside protection and consistency in returns, moderate kind of returns, then dynamic asset allocation funds or balanced advantage funds is the right category. Now, within the large cap segment, you are absolutely right. There have been more than 50% of the funds which have been struggling to outperform their respective large cap indices, right? And and it's very difficult to say that okay, there will be a recovery or not. But as of now, as of today, the data is showing clearly that many large cap funds are struggling. So in the large cap segment, I would give a generous allocation to passive large cap oriented funds rather than active, but not from a downside protection, but just from what do you say, the active underperformance point of view.
The cost also is something to consider, right? But let's talk about fixed income, because here there are some very important choices to make, both if you consider, Rushabh, the mutual fund space and even your traditional products, right, outside of the mutual fund space. What should the strategy here be?
So as I pointed out earlier, that we are in a interest rate hike cycle. So during this time, a lot of mark-to-market hit will happen, and we are going to see aggressive rate hikes this entire year for sure. So investors should be somewhere at the shorter end of the yield curve. Maximum duration should be up to 4 years as per the client's time horizon. But a shorter end of the yield curve will save the investors from mark-to-market volatility. I would suggest, floater funds, arbitrage funds, target maturity plans, and rolled out strategies, in corporate bonds and banking PSU categories would work out well in my view.
Outside of the mutual fund industry, would you suggest even there don't lock in your funds for too long?
Absolutely, I wouldn't suggest. So if it's post office schemes, then don't just stick with say like 4 or 5 years. Allocate only because post office schemes do provide tax benefits under Section 80C. So probably for tax benefit purpose, that's a different issue. But out because the mutual funds are much more efficient in delivering risk adjusted returns, right? So in my view, higher allocation should be given to mutual funds, debt mutual funds, but from a tax under Section 80C, because the mutual funds is also giving you indexation benefit after 3 years, right? So, don't park your money too much out of the mutual fund space. This is my suggestion to the investors.
Fair point. I think we've had a comprehensive conversation. Rushabh, thank you so much for taking the time and for speaking to ET Now.
Thank you, Alex, for having me on the show.